Hey, what's up, guys? Today we're going to talk about how the Fed just raised interest rates and what that means for you as a real estate investor. So let's start with some basic supply and demand things. Basically, what happens if you increase the demand and you have limited supply, what happens is the price of each good sold goes up, which is called inflation. Now, if the opposite happens, if there's decreased demand but increased supply, what happens is that the prices of goods go down. Now, the problem with 2022 for like gas prices, food prices, and then all of that is we actually have very limited supply right now because we just came out of a pandemic. And so we have constrained supply, but a lot of demand because everyone's going back to work. Everyone has to drive to work, so they have to pay for gas, and that's why gas prices are shooting up like crazy. Now, what the Fed is trying to do is bring down the demand side. They can't do too much about the supply, but what they can do is actually try to bring down demand by increasing interest rates. So that's what happened today. June 15th, they basically raised the federal funds rate, which is how they can control the interest rates indirectly. They raised the federal funds rate by 0.75%, also known as 75 basis points. And what this means basically is that mortgage interest rates will indirectly go up potentially. They actually already did. And rates on things like credit cards are directly affected. So, credit cards, HELOCs, student loans, all of those things are directly affected by the federal funds rate. Basically, if the federal funds rate goes up, all those things go up as well. So, we already seen an increase in mortgage interest rates, and there's also going to be an increase in credit card rates and all of that. And hopefully, that'll actually decrease demand for a lot of the goods out there. For instance, maybe people are going to start rationing their food. They're not going to buy as much fancy luxury items or random things, right? So prices should hopefully come down because the demand's going to come down because people are less willing to take out, pay for something on their credit card when the interest rate on that credit card is much higher than it was before. So hopefully that makes sense for you guys. Now, as far as how this actually affects real estate investing, it's really interesting. We're not too sure right now because we don't have a crystal ball, obviously. And unless you're like Doctor Strange, who has the time stone, you can't look into the future. So there's a couple things though that might occur based off of what a normal effect of raising interest rates would be. So the first effect is housing prices may soften or decrease in price. Now, we're not 100% sure that this will happen. In fact, the housing supply is also at a shortage as well. And because there's such short supply, even if the demand comes down on that, it might not necessarily mean prices will fall. For sure, they're not going to fall significantly because what's happening is we have more people than we have houses available right now. The houses are just not able to keep up with the population growth of the United States. So, with housing being a scarce resource, it's kind of like gas, right? Prices are going to stay steady or go up in price, even with the decreased demand for it, right? Gas prices are still very high. The next thing to look at is employee wages. So, usually with inflation, employees start demanding higher wages to pay for things like a mortgage on a home. If they want to buy a house in 2022, their interest rate's going to be a little bit higher. So now, in order to afford that house, they need to have a higher income, a higher salary. And so that's something that's going to be coming on in the next year or two. But the problem is, of course, wage growth is delayed, and it takes some time. It'll take some time to get even a 3% or 5% raise, and inflation being at I think it's estimated around 8%, a little higher than 8% right now. A 3% wage growth is just not going to cut it. You're still going to lose at least 5% in purchasing power. Now, the final thing is the landlords themselves might actually raise the rents to, and this is why there could be a little bit of a spiral, and people are worried about this, is in order to afford the mortgage on property, because they have to pay a higher mortgage, what they'll do is increase the rents so that they can then cover the mortgage and then some. So some things to look out for. Obviously, as a landlord with inflation, rents always kind of go up. That's something that's most likely not going to change. As far as housing prices, I don't think there's going to be a substantial drop. Nothing like more than like 20% or even 10%. I think we already saw a little bit of a drop already, and I doubt we're going to see anything more than 10%. But I don't have a crystal ball either, or I don't have a time stone. So, we'll see in the coming days. What you want to do right now as a real estate investor is make sure that you buy a house that for sure has cash flow. So even though the prices soften or the houses don't appreciate as much within the next year or two, you still have that cash flow every month. Like, let's say you're making $1,000 or $1,500 after your mortgage is paid for and after all maintenance costs, then you're sitting pretty, because even if the housing prices come down a little bit, you have a 1 year or 2 year lease on that property to be paid X amount, and you already know your mortgage value. So as long as you have those two fixed variables, you're going to have a fixed income. $1,000, $1,500 per month is anywhere from $12,000 to $20,000 a year. So still keep investing in real estate even during this time, but be very careful with your numbers. There's actually a lot of opportunity out there. There's, especially since prices might be softening, buyers are getting scared. Everyone's kind of freezing up during this pandemic because they're not sure, okay, what's going to happen with the interest rates? Maybe I should wait for the housing prices to come down, but they might never come down, right? So right now, as a buyer, you actually have a very strong position compared to the seller, because there's a lot of sellers and not too many buyers interested in buying real estate during this time. You now have negotiating power. And what you could do is say, hey, if you don't put up the cost for these repairs before we purchase the property, then obviously we're gonna pack out the deal, and you're probably not gonna find another buyer anytime soon. So, with all that being said, we'll see how the market reacts. It's going to take some time for this all to play out, but definitely just be very careful about your deal analysis. And if you're interested in getting started in student housing right now, there are tons of deals out there, especially with being a buyer. You can negotiate these deals. Even at the higher interest rates, you can still make a ton of cash flow. So please, if you're interested in working with me, just go to my website, www.newbierealestateinvesting.com, and you can sign up there if you want my newsletter for some of the strategies that I provide. It's great for everyone. And if you enjoyed this video, please share it so people get out this great information, and also like and subscribe to promote the YouTube algorithm. All right, guys, I'll see you guys on next week's video. Thank you so much for tuning in, and bye-bye.